There's no doubt that central banks are in rate cutting mode. The ECB, they're set to cut rates this week. The US Federal Reserve will start their rate cutting cycle next week. And the Bank of England will either cut when they meet later this month or leave it until the following meeting. The direction is not the issue. It's the speed and the scale. By year end, the markets are pricing in a total of 45 basis points in cuts from the Bank of England, 62 basis points from the European Central Bank, and a whopping 113 basis points of cuts from the US Federal Reserve. By this time next year, markets expect official rates to be just over 3.5% in the UK, 3% in the US, and just 2% in the Eurozone. That all adds up to a lot of rate cuts. So the question is whether markets will be disappointed. Anthony Fletcher, the UK pension fund advisor, raised exactly this point in a comment on my last Market Perspectives report. Well, let's start with the US. Last week's employment report showed job growth was slowing, continuing a trend that's been in place for a while. But we also had a decent pace of job increases, and the slowdown was really a result of reduced hiring rather than increased firing. Unemployment edged down a bit, and so overall the report was reasonably balanced. Taking account of other data suggests that the US economy is growing steadily. Now, this week's data should show a fall in headline CPI inflation, and although the core numbers are likely to be unchanged on a year-over-year basis, the last 3 months should have seen core inflation running well below the 2% number. With wage inflation slowing and oil prices falling on increased supply, the outlook for inflation in the US is good. But we need everything to go right if we're going to get all the rate cuts priced in for the US this year. Unless the Fed cuts by 50 basis points next week, I think the number will have to come down. And then, of course, there's the prospect of a Trump presidency with a steep rise in tariffs in 2025. Over in Europe, growth has been anemic. Recent data show a significant fall in wage inflation, and price inflation is pretty close to target. In addition, the European Commission is putting pressure on governments to tighten fiscal policy. So all in all, the rate cuts priced in for Europe, they seem reasonable. Here in the UK, we have the smallest number of rate cuts priced in, suggesting that the UK will have a level of rates much higher than Europe and a little above that in the US next year. So there's a distinct possibility that the Bank of England might just deliver more cuts than currently priced. Now, the precise path of rate cuts, well, that's crucially important for bond markets. Equities should simply enjoy the background of continued growth and falling interest rates. Mind you, there's a lot of optimism priced into equities too, as evidenced by last week's weakness against a not particularly bad background. One final point. Weak oil prices and strong sterling mean that the wholesale price of fuel has been falling here in the UK, and that should be gradually passed on to lower prices at the pump. But don't run on a low tank for too long. There's a distinct risk that we get a hike in fuel duty in Rachel Reeves' first budget on the 31st of October. Until next week, goodbye from me.